It's 6 o'clock in London. It's 7 p.m. here in Gibraltar. I'm on the rock for some business with Valerian PLC this week. It's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Good morning, good afternoon, and good evening, depending on where in the world you are today. My name is Patrick L. Young. The IPO-VID Livestream Series 10 starts today. Episode 1, that's number 55 in the aggregate, starts here. Of course, what did we start the week with? Well, February the 14th, that most incredible farrago of multimedia messaging. And therefore, it's only appropriate to remember the biggest birthday boy of them all. Happy birthday, Michael Bloomberg. 80 years young on February the 14th, 2022. Hope you had a fantastic day. Elsewhere, well, Dominic Stevens. Now look, ladies and gentlemen, we produce Exchange Invest, the daily newsletter of the Bourse business. And why do people pay for it? Well, they pay in order to be ahead of the markets and understanding the intel and what goes on in the Bourse business. So we forewarned all our subscribers as long ago as June the 18th last year. And this week, we found out the news that we were prophesying. Dominic Stevens, the ASX CEO, will be standing down and will not seek a new contract. Ping us on social media, wherever you're watching this today, or go to our website, exchangeinvest.com, and you can be part of a free trial subscription for the Business of Bourses newsletter, Exchange Invest. Stay ahead of the curve. Although staying ahead of the curve, well, NSE India was one of the most famous names for being an innovative exchange in the world. The wheels rather fell off this week. In fact, SEBI knocked a hole in the wall of NSE's upcoming IPO plans as they come back with substantial penalties against the bourse itself, bans for the former CEO Chitra Ramkrishna, who it was discovered was actually managing the exchange via her mystical yogi who was based in the Himalayan mountains. A first, I do believe, for the exchange parish. Equally, we saw Ravi Narayan, a friend of Exchange Invest in years gone by, was also banned for 3 years from the financial markets business, amongst other people. It seems, well, a lust for latency or power in one form or another led to a very sorry coda to the previously stellar history of the NSE. But that wasn't all, actually. We also had the excitement last week of a very, very interesting series of money laundering charges being levied. $4.5 billion, no less, is the sum that was apparently being laundered by a New York couple as they tried to get away with somebody's ill-gotten gains from a hack at Bitfinex many years ago, the cryptocurrency exchange. Most exciting of all was, well, the subtext. Part-time rapper Crypto Kaleo, a former Forbes contributor turned crypto rapper, was amongst those arrested for felony. Perhaps one of the most bloodless arrests of a rapper in many years in the American landscape. All this and more has already been covered in greater detail in Exchange Invest Daily, the unique newsletter of the Bourse business. As I said before, hit me up, Patrick L. Young, on social media, wherever you're watching this, and we will be delighted to organize a free trial for you. One of the people who doesn't need a free trial because he's already a subscriber is our guest today, Henrik Hasselknippe. We're going to be talking about holistic renewable energy and carbon. And I'm joined today by Steve Zwick, our guest expert on the carbon market space. He is the podcast host of the Bionic Planet podcast, which is all about the Anthropocene, which just goes to show I must be sober if I can still manage to pronounce that. Henrik is the head of XMarkets, the Xpansiv portfolio of open, transparent exchanges that enable the seamless transition of renewable energy, carbon, water, and digital fuels. Henrik is responsible for the Xpansiv exchange operations, which includes CBL, the largest voluntary carbon market, Australian Water Exchange, the delightfully named H2OX, the Aviation Carbon Exchange, which is another ACE, not to be confused with the other ACE that we were talking to a few weeks ago, and OTX, which provides market access for CSO tickets and renewable fuels. Former executive director for the CME Group. Henrik led the company's corporate development division in EMEA, amongst many other responsibilities over several years, and he also served as MD for GreenX, an environmental markets exchange that was owned by a consortium of leading global investment banks, brokers, and trading companies. Gosh, I'm quite breathless just after managing to get through your CV, Henrik, and that was only most of it. It is a mouthful. So many things that we missed out on the way through that you're going to start with. So the usual starting point, gentlemen. I'm going to start with Steve because he's going to tell us both what time it is in the world at this point in time for him and where in the world he is today. Steve, good evening.
Good evening. It's 9:05 where I'm at. I'm in a little farm outside of Mudetha, Kenya, out where the action is, front lines of climate change.
There you go, on the front lines of carbon, our correspondent today, Steve Zvek. Henrik, where in the world are you today?
So it is 6:05 and I am in sunny Haringey in North London. Sunny Haringey. So liberal that we knit our own yogurt.
I'm actually so old that I can remember when Haringey still had a Greyhound track and they raced stock cars on it. And neither of those lived long enough to manage to see them becoming part of a carbon offset scheme. Let's put it that way. In fact, your apartment's probably where the dog track used to be, I would imagine. Yes, it's changed somewhat.
It's all artisanal sourdough and very expensive coffee these days.
Yes,
here in Crouch End, like it is in pretty much all of North
London. Change over time. How incredible. So, Henrik, tell us, how did you get into environmental markets?
So, thanks, Patrick. So, I've been in environmental markets now since, effectively for 20 years. And, it all started really with, going through school, didn't really know what I was going to do, accidentally ended up starting a PhD in non-thermal plasma physics, which turns out, sounds very impressive, but it's pretty much useless as a discipline. But then wanted to see if I could change careers, and I'd always thought that environmental markets or the environmental science sounded interesting. So moved over to do political science. So then ended up with a degree in chemical engineering and a degree in political science. And it turns out that one of the places where that actually makes sense is in the environmental markets. So sort of stumbled into that, started following the climate negotiations back in 2000. So, we just had COP26. My first COP was COP6. So that's 20 years ago. And then it sort of led from there and sort of varied career doing different things in terms of market analysis, research, consulting, eventually going into the exchange space. And here I am today running a number of different exchange operations within Xpansiv, which is the world's leading and sort of probably fastest growing environmental exchange.
So tell us a little bit actually about the background, because Xpansiv is a fascinating private company, isn't it?
It is. So Xpansiv is effectively two companies that merged in 2019, and I have to also say that all of this happened well before my time, so I'm sort of taking credit for other people's hard work here. But you had two companies, CBL and Xpansiv. CBL is a commodity exchange, was founded in 2009 by Nathan Rockcliffe and Ben Stewart in Sydney, which very early on started focusing on the environmental markets and building out a position there. And Xpansiv was then is a sort of data sciences company, Silicon Valley based, but looking at the market from a slightly different angle, more sort of back-end registry connectivity, developing infrastructure, developing smart contracts, etc. And then these two companies, started working very, very closely together, and eventually realized that they would be better off, being together, and then joining forces, and then merged in 2019. But what we are able to do effectively through the merged entity is provide the first and ever sort of complete back to front service solution for ESG commodity markets. So if you look at the environmental commodity space, what you're trading is effectively a digital certificate, something that needs to live in a registry somewhere. So we've built connectivity to those registries. On top of the registries, we have our portfolio management system, which allows you to move things between the different registry accounts. And then on top of those registry systems and portfolio management systems, we've built our exchanges, which can do standard sort of spot physical market transactions. And then on top of that, again, we have our market data business, where we've licensed this data to futures exchanges such as CME Group, but also to other market participants who want to use it. So we effectively cover everything from sort of the sort of initial registration and sort of storage of the units that are traded, all the way up to the actual physical trading, to licensing that data to futures exchanges. So it's sort of a complete ecosystem covering all the different aspects of ESG commodities.
Fascinating. So you're a full front to back, soup to nuts, vertical silo in the ESG business. That's really, really interesting. We're here with Henrik Hasselknippe. We're talking about the carbon markets once again this week, ladies and gentlemen. Let me just say hello to a number of our regular viewers. Greetings to Les Calvert. Thanks very much for joining us this evening. Hello, Simon Huckle. It's lovely to have you with us. Peter Secon as well, regular viewer of this program. Anthony Clancy and John T. John T, I believe you're coming via YouTube. Good to have you all joining us in the show. Thank you very much. Feel free to ask a question of our guest, Henrik Hasselknippe, this evening. Steve, let me throw the conversation over to you. And you're muted, Steve.
Sorry about that.
It looks so
yeah, I was going
lively.
to ask. What's that? Yeah, well, there's lots
so
of bugs
lively.
flying around here. Okay, I'm swatting flies. So I had a quick question to kind of get us started, because there's so many different directions we can go here because of your background, and I think there's one that I wanted to start with. It's just kind of simple, which is how CBL evolved internally towards its current structure. I know you came kind of late, but maybe you can talk to this. We were watching this from Ecosystem Marketplace, and if I go back a couple of years ago, all deals were done bilaterally. Nothing was done on exchange. Everybody was using the exchanges to basically dump their remnants. If the project developer had done a lot of work and had, they'd sold out, they negotiated a big deal and they had a couple of small offsets left, they would put those on exchange. And by the end of last year, they were predominantly working on exchange to execute their trades, which is interesting in the land use space, because these products have historically been negotiated bilaterally. And I'm just wondering if you could talk to what precipitated that. What do you see as the turning point that made people shift from being almost exclusively bilaterally to doing a significant portion of their business on exchange? And then we could also maybe segue into what is still being negotiated bilaterally and how these interact.
Exactly. No, thanks for that, Steve. I mean, there's a lot there. I think really, the big turnaround was the introduction of the first standardized contract for carbon offsets, the GEO contract, the global emissions offset contract, which was launched sort of late 2020, but really took off in 2021, both as a spot contract and then later as a futures contract. But that was the first time that the market had what is effectively standardized commodity contract. So really, what drove the change was looking at, you have a commodity market, which is the carbon offset space, which was acting completely different from most other commodity markets. It didn't have the tools, it didn't have the instruments that you would recognize from other commodity markets. So the team looked at that and developed the GEO contract, which is the first time you have a reference framework for what can be delivered into a carbon offset contract. So in many ways, it's similar to, if you've been around the carbon markets, it's very similar to the CDM contract or the CER contract back in the days, only that, that was based on compliance for the EU ETS system. What we did here was take something slightly different. We took the CORSIA, so the airline emissions trading program, and used that as the starting point to develop the GEO contract and then define what are the deliverable units into it. I come from, both environmental markets, but also the energy markets. And I sort of like to say that, the GEO contract is a bit like the Brent contract for environmental markets. Whereas if you know your oil markets, you know that Brent is effectively 5 different oil fields that can deliver in. So you've got different grades of crude oil that can be delivered into Brent. That's effectively what the GEO contract is. It's not specifying, it's wind or it's solar or it's anything else. Basically just says, here are some project types that will qualify. Here are the characteristics of those project types. And, that will then, become the deliverable units. And once you start then to have those benchmarks emerging and to have transparent pricing around those contracts, you then start to see much more liquidity flowing into the space. You start to see much more interest from established financial market participants who recognize these tools and recognize these instruments because they're what they use in other markets. So, that combined then with working with CME Group, and I should caveat this and say that I was at CME Group at the time that Xpansiv and CME Group entered into this agreement. But CME Group then launched the futures contracts that then provided access to the market and pricing for a whole other set of market participants. So all of these things working together is really what has been driving the interest that we see. And then we've launched other standardized contracts later, but it all comes from the same fold in terms of what are the tools that exist in existing commodity markets, and can we apply those to the carbon offset space?
Very interesting. So just run back through one thing for us, because for those of us who are not experts like your good selves, CORSIA, talk us through what that means from the airline industry, please.
So CORSIA is the program for the airlines, where effectively, the global airlines got together and said that they wanted to reduce emissions, and they wanted to put in place a framework that would allow them to create a system that was better suited to meet their requirements while still reducing emissions. So they've effectively entered into, let's call it a voluntary but enforced compliance system, where the airlines themselves set limits on what their emissions will be. And then within that system, they can then procure offsets in order to meet those targets. So CORSIA is effectively the airlines emissions trading system. It's voluntary, but it's a voluntary compliance market, if that makes sense.
Okay, and so it's a voluntary compliance market, and then from that came GEO. So explain to me a little bit how that sort of jumped into place.
So within the CORSIA market, so CORSIA is where the airlines then got together and said, here is what we will allow to be used for compliance within our system. So we took that as a starting framework, and we said, okay, that's one set of deliverable units, and then consulted with market participants, more broadly, because even if CORSIA allows a number of different project types, there aren't all the different project types that the market itself would want to have in it. So working with that market consultation, we then arrived at a set of specific contracts. So effectively, the start date of the project has to be 1st of January 2016 or newer. It has to be from projects that has its sustainability report completed. It has to be from these specific registries, etc. So it's all sort of a list of where you can then, if you are buying that contract, you won't know exactly what project you get delivered, but you do get delivered something that will fit within that basket. So it's a deliverable basket of commodities, effectively producing that overall benchmark price. As I said, very similar to how Brent oil is a collection of different oil fields.
Fascinating. Steve?
Yeah. Oh, you've also got the NGO, right? And
yes, exactly.
And I'm trying to remember, is that all a broader universe of nature-based products, or is that only nature-based products from within CORSIA?
No, exactly, and that's a good point. So it is slightly confusing, even to me sometimes, but I've got smarter people than me working on it. What we talk about is the GEO suite. So we talk about the global emissions offset suite of products, and within that we have different products. So you have the first contract that we launched, the GEO, the original GEO contract. Then you have the nature-based global emissions offset contract, which isn't a subset of the GEO itself. It's just a different version of it. So you can think of it as technology. GEO is technology-based for aviation, and NGO is just pure nature-based, using some different criteria. So that's the easiest way for me, because I'm a simple person, to think of it, is tech-based and nature-based. It's renewable energy versus forests.
Right. I've got a follow-up, if you don't mind. It's because on the NGO, there's an interesting dynamic that's happening right now, which is that we had this huge oversupply because of all these organizations that have gone out and developed all these forest carbon projects. And as those get used up and prices start to rise, you've got a couple of things happening. One is you've got people who develop forest carbon projects holding on, not selling at the low prices they were. And then you've got all these other projects that are completely different project types that can now become implementable, but are not yet there. So they're going to need upfront finance. They're going to need a way to kind of move forward and price forward. And so from an exchange perspective, you're going to have existing products like Red Plus, which is the avoided deforestation. You're going to have afforestation, reforestation, and now you're going to have all of these newer agriculture products that are going to start kicking in at a higher price. And I'm wondering how you see yourselves managing this transition, both from the perspective of an exchange trying to create a benchmark price, and also from the perspective of an exchange trying to provide forward finance to these newer entities.
Yeah, exactly. So I think, you know, the forward financing part is probably the easiest. And
Mm-hmm.
I know, we don't ourselves do forward transactions, but what we've done by working with CME Group and licensing our prices for futures is that you now have a future reference price. So if you are a market participant, you're looking for financing and you're talking to lenders in the space right now, you know, those lenders can actually use the established financial markets to lay off some of the risk that they would have involved with financing that project. So, you know, we are again starting to see the emergence of an ecosystem where the tools that we have put together, you know, are starting to deliver tangible financing results on the ground in developing countries, right? Where when we launched the NGO, the price of NGO was $5. It's now $15. That's a huge difference if you're developing a forestry-based contract. And then, you know, that's, you know, something that's just going to continue. And I don't mean that in terms of sort of forecasting prices, but in terms of sort of the maturity of the market and the maturity of instruments around it. The other thing is you know, yeah, there is going to be an emergence of new contracts or new product types and new projects. And that's where it's important to think of, you know, what is the benchmark? Because not everything is going to fit into the NGO contract, but we also aren't going to be launching, you know, 1,000 different contracts either, because then the whole point of standardization disappears. Like that's the whole point of, you know, I like to say that, you know, everyone loves standardization, but everyone wants to have their own standard that reflects their own unique portfolio. But, you know, what you can start, or what you can see and what you are starting to see is market participants pricing their projects on a sort of differential basis to the established benchmark. So you're looking at, you know, people pricing themselves on a bilateral basis or on a forward basis as NGO plus or minus, or GO plus or minus. And again, you then end up with that basis trading, which would be, again, sort of very similar to what you have in natural gas markets, or again, oil markets, right? Where you're trading Henry Hub plus minus, you're trading TTF plus minus on a locational basis, you're trading Brent plus minus. You know, so, and these markets will then start to relate to each other and price off each other. Not all of them will necessarily be futures contracts. You know, we don't do futures ourselves. We want to very clearly do spot. That's what we think we can do best and where we can make a difference. But then by having those spot basis contracts, you can then start to have price points but it all comes back to those liquid benchmarks that we have established around the GEO and the NGO contracts.
Mm-hmm. And I guess the question on that is still the differences in the emerging product types are so different. They're more different than Brent. You know, how can this? I still, you know, how can this serve as how can you have we have a benchmark for things like, you know, blue carbon versus, you know, and forestry, or you know, how do you see this evolving when you've got so many huge differences, and the way the market seems about to start ratcheting up, not just seeing the price of one thing increasing, but you know, new product types coming in.
Yeah, and listen, again, this is where it's fairly easy to be a spot exchange. Like we can spin up a contract for that fairly easily.
Okay.
You know, you know, where you know, the question then becomes, you know, for the marketplace, whether they want to price that contract on a standalone basis or whether they want to price it as a basis differential. I think for something like, you know, blue carbon, you know, looking at that, you know, I think there's a good argument to say that, you know, blue carbon could potentially be its own benchmark. It could be its own sort of, you know, specific project type. But, you know, it's probably going to get priced, you know, in relation to some other things. Then you have direct air capture, which I think is a completely different thing again, which you can also start to get prices around. But that's where what we do and the systems that we've built, where we onboard the market participants, and we effectively have access to their registry accounts where they have the offsets or they have the units that they're looking to sell. We then have access to their cash through their bank accounts. So we have sort of pure sort of central market facilitator role, where we run on a sort of delivery versus payment basis, T+0 settlement. So massively reducing counterparty risk on that. So for new project types like blue carbon, our platform is a perfect place to go in and get initial price discovery around some of those things, because we do the standardized contracts, but still the majority of our volume is still in individual projects, right? Because that's the way the market that's the way the market is trading still, mostly. But at the beginning of last year, our volume was probably less than 5% in standardized contract. At the end of the year, it was more than 15% standardized contract, and then that trend is going to continue. Where we feel fairly confident that over the course of this year, it's going to become predominantly standardized. Whether it's this year or sort of early next year, but that's the direction of travel, because that's what we've seen in other commodity markets and what we would expect to see here as well.
So that's a very interesting point. I mean, you made a very pithy comment about the fact that you're looking at standardization, and it's a great thing when you can manage to have fewer benchmarks, but everybody loves having their own standard. How does that actually play out in terms of the number of likely markets that we're going to see around what is, let's face it, as you said, a cornucopia of different possibilities for carbon?
Yeah, I mean, it's difficult to say exactly what it's going to look like, but if you look at a market like natural gas, you have multiple natural gas prices around the world. You have multiple different delivery points for natural gas, but really you have Henry Hub, TTF, NBP, so or sort of US gas, Dutch gas, UK gas. If you're not sort of deep in gas markets, and then you have LNG, and that's kind of your global benchmark of gas prices. And the Italians will complain that we're not mentioning theirs, and the Germans will complain, but frankly, it's all based around the Dutch gas. So you could easily see a situation like that developing in the carbon market as well, where you have 4 or 5 global benchmarks, but you maybe have 100 different prices around it. I think you're not going to get to 100 sort of immediately. I think the market is probably going to contract and converge first around the benchmarks, and then once you've established the liquidity around the benchmarks, you're going to start to then see basis prices create around it. But again, this is where we have the flexibility to help serve the market as that develops, and that's really what we've done here is we've helped the market by creating the benchmarks and creating the instruments out the gate.
So it's very interesting, because obviously Xpansiv, you've had actually an amazing expansion over the course of the years. What does your market structure look like in terms of user base? I mean, have you lots of commodity players, financial players, or is it carbon projects themselves?
So this is where it's really important that I give credit to the guys in CBL and all the hard work that they did over the years, when many other people within the carbon markets, including myself, I'll be honest, sort of looked at the carbon offset space and said, it's interesting, but it's a bit hairy, and it might never sort of account to anything. But they stuck at it, right? And they really built those relationships and built the networks. So to the point where we have about 150 project developers onboarded on our platform today. So that's sort of the starting point, right? So we've got very good connections on the supply side. And then historically, if you look at the space, you've had sort of specialized market participants and specialized and environmental traders. What we're increasingly seeing now is the introduction of established commodity traders, established energy firms, very large financial institutions, all entering the space. And again, a large part of that is now driven by the fact that you have these standardized products, you have these financial instruments and tools that they do recognize and know how to use. It's easier to get your risk manager to approve trading something that has a futures contract associated with it on the CFTC regulated exchange than it is to get them to get their head around sort of individual projects in a developing country. So we're definitely now, and I think I've said this other places, our biggest challenge at the moment is managing the inflow of new participants and the onboarding of the new participants, because obviously we need to undertake our KYC checks. There's the background requirements, setting everyone up with accounts, etc. So it's increasingly becoming very much what you would expect to have in any established commodity market, Patrick, with a mix of market participants, but I think there's still a ton of growth to be had in this space.
Fascinating. Steve, I think we've got a question.
We do have a question coming in. This is from Peter Sekon. He says, what future challenges do you face on carbon credits in terms of regulatory validation so they can be sold by brokers?
Yeah, so I'm not entirely sure if I get the question, so apologies to that, Peter. But I think one of the big things that the market is looking at right now is in terms of integrity and integrity standards. So you've got some very important work that's been done by the Task Force on Scaling Voluntary Carbon Markets and the new sort of Integrity Council, which is following that, which is addressing some of the points that I think Peter is looking to get at in terms of the market wants to make sure that what they're buying is of high quality, and they want to make sure that what they're buying is of high integrity and it meets certain standards. And all of those are new guidelines that are coming from the market, or from this Integrity Council. We have already launched our first standardized contract that we believe will be aligned with the core carbon principles that are coming out from the Integrity Council, even if those principles haven't been announced yet. So we've launched our CGO contract, or the core geo contract, which we launched early this year. We're already seeing very promising liquidity on that, market uptake, and I think last week CME Group announced that they're launching a futures contract on that shortly. So again, what we are seeing in this space, and having worked in commodity markets for some time now, what would typically take a commodity market sort of 2-3 years in terms of sort of initial establishment in the spot market, then see how the liquidity develops, then get some pricing in place, then launch a futures contract. That would take 2-3 years. We're now doing that in sort of the space of 3 months.
Fabulous altogether. Let me also just say hello to, I think, Anthony Clancy. We didn't speak to you earlier on. Thanks for your message. Hello, Sachin Patel. It's great to see you as well joining the show. Peter Sekon, I hope that answered your question. If not, feel free to come back with a supplementary. And in fact, we've got another question coming through from John T. So, Henrik, you just mentioned a ton of growth. Maybe it was a ton any, I'm not quite sure. Are there any major blockers to growth now?
Scale. I think if you look at the carbon offset market more sort of generally, what you've had is, or what you've had is there's been a large oversupply in the market historically, but that's sort of rapidly being eaten up to the point where it is now probably sort of supply constrained market if you look at the higher quality credits and the things that would qualify for the standardized contracts, and a large part of that is obviously driven by the price. So if you look at the geo contract, apologies, I mean that increased, the price of the geo contract last year increased 900%. It's probably the largest growth of any commodity globally, which means that if you were investing in a project that would qualify for geo at the beginning of the year, you were doing that at $1, and when you were, less than $1, and at the end of the year it was closer to $8. So what has happened then is that a lot of the supply has been taken out of the market, but you now have a completely different investment scenario where people are investing at $8 for technology based, or $7-8 for technology based, or investing at 14-15 for forestry based, which means you've got a massive influx of capital coming to the system, but the system itself hasn't scaled up yet. So you're then having to deal with that interest from the demand side, but it takes time for the supply side to invest into these new projects, to stand up the new forestry projects, to install the new windmills or solar cell panels. So there's going to be that lag in terms of the price signal now feeding into the supply side, and then it's all going to happen. But right now the challenge is scaling that interest, whereas what the market has done so far is growing. So you're growing both your top line, but also you're growing your cost, and we're now at the stage where we're looking to just scale.
Mm-hmm. I've got a question too that's related to that. Within the avoided deforestation REDD+ sector, we're also seeing the shift towards jurisdictional offsetting. We've got the LEAF Coalition, which is doing only jurisdictional offsetting. Vera, which I'm doing some work for. I should disclose that. But they're shifting to this JNR, jurisdictional nested REDD, where they will have jurisdictional offsets, but with individual projects nested inside of them. And I'm wondering if this is going to change. And one of the key elements of LEAF, the LEAF Coalition, and even a lot of the newer offsets coming out is this risk sharing component, where if you are a middleman who buys or if anybody buys from the LEAF Coalition and then resells it, any additional benefit has to go back to the original generator of that, which makes sense because it's not like a regular commodity. It is a service, and you're paying for a service, not just a commodity. And from what I understand in talking to brokers, that's happening with the individual projects as well, where they'll if a broker buys from a product developer at a certain price and they then resell it, they have risk sharing components where they have to share a certain amount of that back to the project developer. I'm wondering how this will impact. How does an exchange deal with that, or do you just does it remain invisible to you, or is it something that can be dealt with, through adjunct contracts or something like that?
I mean, the short answer we don't.
Mm.
Market participants who are, and it's great to sort of have that question sort of coming from Kenya, where you're much closer to all of the projects than I am. But the simple exchange answer is we don't get in the middle of the bilateral contracts that are between project developers or brokers or anyone else. So what we do is that we provide the ability to sell once you have something that is issued and you have it, and you want to sell it and you want to buy it. We will flow that. We will make sure that the buyer has the cash that they're looking to pay, and we know that the seller has the offsets that they're looking to sell, and then we will flow that transaction on a DVP basis. What I do think, though, more sort of structurally, is that it introduces a really interesting aspect where it comes down to the point of who is it that these markets are looking to benefit. And I think it is important that a lot of the proceeds from these projects do go to the local project developers. And in that sense, I think it is good to see that there is some level of risk sharing, and that if the price does increase massively, that some of that in price increase could go back to some of the developers. But that's more of a sort of general statement and sort of my view of the world, rather than me as a exchange director, where we are always going to be neutral as a central market facilitator.
Right. How I wonder if it's even relevant if in terms of, are you even seeing middlemen buying and reselling, or are almost all trades, is it project developers on one side, end users on the other? Like how many intermediaries really are there right now on the exchange, at least?
I mean, hard to give you a number, but I mean, another way to answer your question, which will be sort of more familiar to sort of the listeners from the exchange space or from the commodity space, is what's the churn in the market? Are we trading the same units many times over? And definitely there's more trading. There's churn in the market. The churn is still fairly low, I would say, for what is effectively a sort of electronic asset that's fully storable, that doesn't degrade. Spot trading of carbon offsets is very different from spot trading of, let's say, natural gas or electricity. Like you spot trade electricity, you spot trade it to use it. Carbon offset, you spot trade it, you get it, you can just store it in the register account, you can sell it again a year later, it will be perfectly fine. It's not like wheat or corn, it's all gone bad. So in that sense, you should be able to see a lot more churn trading happening within the space. So we are definitely seeing that. It's still at a low level, right? I think we're probably looking at churn that's less than 2x. It's less than 2 times the underlying that's being churned. Whereas if you look at the European emissions trading scheme at the very early days, that was churning about sort of 3-4x. That market is churning about 10 times now. You look at Bitcoin, Bitcoin churns about 10 times the underlying physical. You look at crude oil churns 25 times. You look at natural gas churns 50 times. So these are numbers that we look at very carefully, because we are forecasting what is the potential growth for the carbon offset space from an exchange perspective. Because one thing is, yes, it will grow in terms of the underlying supply, and the underlying demand will grow as well, because more companies have net zero demands and net zero commitments. But then the actual trading of it is going to increase as well. And then so what we're looking at a market that's going to churn on 2 levels. You're going to have churn at the spot level, where contracts are traded over and over. But then you're also going to have churn at the futures contract level, because the futures then relate back to the spots. At the moment, the churn we have on the futures versus spot is 10x, which again is probably healthy, but that could easily go to like 100x. So so there is that trading back and forth, but at the same time, we traded over 300 individual projects last year. The latest futures deliveries that we managed for CME Group, so we managed their physical deliveries. The geo contract that delivered from 30 different technology-based projects, and the NGO delivered from 17 different nature-based forestry projects. So there's diversity within the pool of offsets, and yet there's churn on top of it. So you don't have you have a healthy situation where it's not just one project type that gets churned back and forth between like the same market participants, but also we have a lot more room to grow if you look at how different markets churn in more established commodity sectors.
Okay. Fascinating, very interesting altogether. I do believe we've got a message from Chris Messina on LinkedIn, although I can't actually see it on my screen at the moment. If someone can locate that, perhaps they can flash it up on the screen. It's fascinating here. We're talking carbon with Henrik Hasselknippe, the energy and carbon markets. He's with Xpansiv. We're talking about their spot exchange and also their relationships into the futures markets with CME and others. Henrik, fascinating to hear about this and how you deal with so many different enterprises, different projects. You mentioned 300 just a couple of minutes ago. Explain to me one thing. Your registries, what sort of technology are you running there? Is there a lot of blockchain usage, for example?
Yeah, no, good question. So, on the registry side, it's important to point out that we do 2 things. So one is that we connect into all of the existing registries. So that would be, your Verra and, ACR, American Carbon Registry, and, the Climate Action Reserve in California. So we've built sort of direct connectivity to those. And then also we've done the same thing on the renewable energy side for sort of renewable energy credits in the US. That's all based on the existing technology that's in place at the registry level. So, in many ways, that's where you've got probably the most outdated technology, but again, that's not controlled technology that we control ourselves directly, but somewhere where we've just built pipes to it. But then we also operate our own registries. So that's where, in some of the new markets that we're getting into now, like methane performance certificates or differentiated natural gas, where these markets don't exist today, but we've talked to market participants who say that there's a demand for it, there's a need for it. And there we actually operate the registries ourselves. And there we do use, the latest state of the art, distributed ledger type technology approaches. I'm not a technologist, as you'll soon find out, but that's where we're leapfrogging, and we're using, instead of on the existing technologies, we've found a way to deal with yesterday's technology in a seamless and meaningful way. But if we're now creating these new things from scratch, we're going to use state of the art.
Can I see we've got another question coming up, but I've got a related one. If I could follow up real quick, although you did say you're not a technologist, so you might have to take a pass on this. But it's interesting that the carbon standards, Vera and Gold Standard, are both dramatically increasing their digitalization. It's been a huge backlog, as everything's still done with faxes and PDFs, and both are going digital in a big way, where every project from the very beginning, from the time it's a project idea node to a PDD, it's all going to be digital, and it can accelerate the whole process of development and everything, in verification, validation, etc., which should speed up that pipeline issue. But I'm wondering if that would also have any impact at all in the market in terms of data or anything else that could be fed in to how exchanges are adapting to these really quick advances on markets that have not been perceived as being all that up on the digital age.
Yeah. No, I think there's tons of improvement that can be done within the existing infrastructure, and moving a lot of the information to cloud. I think there are opportunities there from an exchange perspective, but I think probably even more so from sort of information providers, from rating agencies, from larger institutions that are looking to do analysis in this space. Again, that was one of the things that was surprising to me when I sort of came back into environmental markets after having been in the corporate development side for a while, and I came in to look at the offset space. There weren't any established research providers. Like, you had Ecosystem Marketplace, which did a fantastic job, but they were literally the only one. Like, you looked at Bloomberg, you looked at Reuters. I called up my old friends at Point Carbon at Reuters, and I sort of asked them, hey, what are you guys doing on voluntary carbon? And they're like, yeah, we're not really covering it. So, but you're starting to see that happening now. You've got companies coming into this, like, Silvera on the rating side. You've got companies like Trove on the research side, and you're starting to see those players come in, and they will all benefit from that digitization that is happening. And then I think, ultimately longer term, is the market going to be trading around smart contracts and distributed ledger? Yeah, I think absolutely it will. But right now, as I said, it's kind of hard enough to get risk managers to understand what carbon offsets are, without sort of having to explain to them carbon offsets on a smart contract.
Fascinating. Okay, so we've segued into technology. We're going to have Steve coming back in a moment. He's got a question from John T. Apologies, ladies and gentlemen. We have got a slight connectivity issue with LinkedIn this evening. These things just happen. Thank you so much, Chris Messina of the Messy Times podcast. You've also added your question onto the YouTube feed. A related question: are the quantity and diversity of market participant types growing, or is it static?
Growing rapidly, and as I said earlier, probably our biggest challenge is making sure that we manage that influx of new market participants, and do that in the way that we have to, as a central market facilitator and an exchange operator, with all of the background checks and registrations that we need to do. But again, I mean, we're onboarding significant number. We're going to be onboarding hundreds of market participants this year.
Okay, and I guess we've got another question here from John T. Right? Is that coming my way, or?
Oh,
Here we are. Okay. It says, excuse my potential naivety. This is very interesting. Is the demand for these products more from institutional investors, or are private investors becoming more keen to invest? Thanks.
Yeah, good question. I would say definitely institutional. I mean, we do not have a retail offering, although I think potentially over time that's something that could be developed. But right now, it's important to keep in mind that the demand in this market comes from corporations that have made net zero commitments. You have more than 10,000 companies worldwide that have made net zero commitments, and will need some form of offsets in order to get there. And then you have all of the financial institutions that provide financing within the space or act as intermediaries, or just on behalf of their clients. So I would say very much institutional investors at this stage, but with a potential for private and retail, but that's not really where it is at the moment. I'm sort of leaving. There is a sort of crypto component of the market, but that's not what we do. Our products are very different.
Okay, we've got another question coming in. This is from Simon Huckle. It says, "Evening, Henrik. Carbon credit volume passed 100 million metric tons in 2021. Will this be doubled in 2022?
Sure hope so. I'm hoping to get a bonus at the end of the year. Yeah, I mean, listen, the trajectory there is, I think if you look at last year at this time, we had traded about 3.5-4 million tons. We're now up to 18 million tons so far this year. So that sort of tells you a bit of sort of the year-over-year change that we're seeing.
So we got a fascinating question here from Robin Ransom. A water exchange question. It's a subject discussed behind closed doors for decades as populations continue increasing at incredible rates with readily available natural sources of fresh water unable to keep up. How do you see, and of course bear in mind the fact that we are talking to a representative of H2OX, at least from the UK arm of the Australian Exchange, how do you see the political future of water, and how do you see the growth of water trading exchanges?
I think, well, first of all, thanks for the question. I was coming to the end of my carbon knowledge. I mean, the water trading market is fascinating, right? So we operate the H2OX, which is Australia's leading water rights and water entitlements exchange, where the water market is obviously a very regional market, and it is going to be largely driven by compliance regimes and policy regimes. So that's one thing that we should have as a starting point. It's very, very hard to look at water being a globally transferable commodity. However, there's nothing to stop the water market from applying the same financial instruments and the same tools within the water markets as we've seen in other commodity markets. So our approach in water markets is going to be very similar to what you've seen us do in carbon, which is look at what does the market look like, which tools that exist today in other commodity markets have not been applied, have not been used, and that's what we're going to be doing in the water space. So is there a relevant futures listed water contract? No, there isn't. Do we think we can develop a spot contract that could potentially one day help launch one? Yes, we do. So that's the approach that we're taking. But again, water is probably going to be much more regional, and in many regions much more political, because you're dealing with farmers and people who grow things directly on the ground, but hugely important in terms of distributing that as a scarce resource.
Steve, Annika K has a question.
Okay, this is from Annika K, as you just said. She says, "You said earlier a lot of your business is around projects. How do you validate the projects and the fact that some project is not oversubscribed, meaning sold multiple times?" Well, yeah.
Yeah. So exactly. So no, but listen, it's first of all, as an exchange, we're not a validator. So we don't validate the projects directly themselves. What we do though is that we through the process that we have, and as I've explained, because we have the connectivity down at the registry level, if someone is looking to sell something, it's encumbered. And we see that it's there, and we know that they have it there to be sold. If someone's buying something, we know that they have the cash, and once they buy it, it flows, and then it's sold. You can then potentially sell it multiple times, but you're selling different things. It's not the same projects that's being sold, it's the issued credits that are being sold multiple times. So, again, it's not the role that we play as a validator, but, the actual underlying infrastructure on the exchange means that, we do guarantee that, the seller has what they're looking to sell. And that
Very
it's
interesting.
Yeah.
I think we've got several questions. We just got to run through because we haven't got that long time left, I'm afraid. Good and interesting question there from Chris Messina. I'm going to come to that in just a second. Good evening, Bob Paul. It's lovely to see you, inviting us, talking to us all on the show. Thank you very much. Good evening to you in sunny Philadelphia today. Olivier Lejeune, he asks an interesting question related to the crypto world. Henrik, do you see the recent carbon crypto projects such as KlimaDAO and Toucan as potential threats for CBL? They have attracted some good liquidity.
Yeah, well, hi, Olivier. Thanks for that question again. It's not the first time Olivier has asked me that question. Do I see it as a threat? No, I don't. I'm still trying to understand exactly what the carbon and crypto projects are. They're sort of, unauthorized tokenizations of a issued commodity, and where I struggle is looking at something which is a issued credit which is then taken off the market and on chain, and then is bonded into another crypto initiative, and I'm still struggling to understand exactly what it is you're trading at this point. But you're effectively looking at a market where the price has gone from $3,600 to $25. It is a completely different instrument than what we do. What we do is based in the underlying physical markets and the movement of issued and verified credits between registry accounts for cash, encumbered and guaranteed through central market facilitator at the time of purchase on a T+0 settlement. It has no relevance in my view to what Toucan or KlimaDAO deal with.
Right, very interesting. Thank you, Henrik. So we've just got a few minutes left. We're going to try and rush through a couple of questions. So Anita K, she's coming back. You can just clarify this. So they have to retire at some point, these credits. You do not seem to get involved there.
We can. No, but we can. If you want to buy something and retire it, we can help you retire it, and we can have you help issue a retirement certificate for you. That's fine. We can do that.
Great. And therefore, quite quickly, we've got a question from Chris Messina once again. Are you open to the idea of tying carbon products to, say, battery critical mineral products? The idea being an investor can link an investment thesis to carbon reduction and underlying components.
Yes. I think one of the next phases that we're going to see in the carbon market is going to be bundled carbon contracts, where you look at sort of carbon neutralized commodities, and whether that's then sort of a bundle of carbon with oil, bundle of carbon with LNG. We're seeing, carbon neutral LNG cargoes being sold fairly frequently. That bundling, I think, can happen definitely within, metals markets and in agricultural markets as well.
That's fascinating altogether. Really, really interesting. So let me ask you the last leading question then of the day rapidly as we hurry through here, as we unbundle our show. Where do you see the revolution going next, Henrik?
Fuels. So the area that we are working very actively on right now, as I mentioned earlier, is in the space of methane performance certificates, differentiated natural gas. I think there's a huge potential for differentiated crude oil. But, within the commodity markets, we tend to look at fuel products and gas and oil as sort of homogeneous products. And what we're looking to do here is sort of extract some of those intangibles and create sort of tradable certificates around that. So, expect to see a lot of more of that coming our way, whether that's, in the form of sort of methane performance certificates, digital natural gas, digital other fossil commodities. But that's a huge direction of travel, and we're seeing a big influx of capital to that space.
Revolution on revolution as we look to bundle yet more into this incredible space, and that's absolutely fabulous. Let me just say very quickly, thank you very much, Peter Secon, for your contribution. Thank you also, Simon Huckle, Les Calvert, Anthony Clancy, John T. Thanks for the question. That was really excellent. Ian Miller, Sachin Patel, And also, Chris Messina, several great questions from you this evening. Particularly enjoyed the input from Robin Ranson. And thank you very much, Bob Paul, for your questions. Olivier Lejeune and Anita Kay. Really appreciate a Woman on It. Join us 6 o'clock tomorrow for the Woman on It weekly live stream. Super altogether stuff, ladies and gentlemen. My name is Patrick L. Young. I want to say very quickly, thank you very much, Steve Zwick. Thank you very much, Henrik Hasselknippe. We'll be back talking about inflation this time next week. There's a big topic for you all. My name is Patrick L. Young saying thank you very much for watching the IPO-VID live stream. We'll be back this time next week.